Now, I spoke to the deputy head of the African department of the IMF, Catherine Petillo, when the April outlook was released. I started our conversation by asking her what backs this forecast for growth of 4.2% next year, given the damage done to incomes and jobs by the pandemic, weaker currencies, and double-digit inflation.
The things that would contribute to the increase in consumption and investment are factors like the expectation that there'll be a slowdown in monetary policy tightening as inflation is expected to go down further. So that would mean a slowdown in interest rate hikes, which would create more incentives for investment and consumption.
One of the key themes that really has been coming up when we talk about the regional economic outlooks for Sub-Saharan Africa, debt distress, the number of countries that are at high risk of debt distress, the number of countries that are already in some sort of debt distress, that essentially has been going up year after year after year. And you're flagging the increasingly limited access to private capital markets. If I understand your answer, though, I mean, the limited access to markets is going to be a problem, not just this year, but to some extent next year as well. Am I reading that right?
Yes. So we're expecting that a number of the factors that are driving this funding squeeze are likely to persist. Global interest rates are likely to stay high. Some of the reduced flows like aid, reduced flows from China, likely to persist. The factor of many of the frontier markets being effectively shut out of international capital markets and the very high spreads. Some of this we would hope would get better in the next year. And on your general question then about debt vulnerabilities, so yes, debt vulnerabilities are elevated in the region, and many countries have debt indicators that are flashing with risks or indicating a high probability of stress.
Because there's no, these are not directly comparable problems. They're not, the reasons why Zambia is in debt distress and why Ghana is in debt distress are completely different. But I want to pick up on that point around the G20 common framework. It's been pretty slow in sorting out the problems that some of these countries are struggling to deal with. And you do make some recommendations on how it can be made to function better, more efficiently in this report. You call for example, an automatic standstill once a country agrees to an IMF staff program, much earlier sharing of data between creditors and international financial institutions. But what do we need to do to make these recommendations have teeth? Because this is a conversation that we also had in 2022, but to date, it doesn't seem like anything really has changed.
Yes, so far the process has been slower than we thought it would be. And the issues are complex and as you were saying, vary very much across countries. And the coordination among creditors has been challenging. So we have seen some progress in the case of Chad, for example, and we hope this momentum can accelerate and contribute to further progress. On Zambia, discussions are ongoing, and we hope an agreement can be reached soon. So what more can help? Right now, during the spring meetings, there will be a meeting of a new global sovereign debt roundtable. And this is a new framework that the IMF, the World Bank, and India, as G20 chair, have put in place. And it's then bringing together public and private creditors as well as the borrowers.
I just want to go back briefly to the question around debt. 4 countries right now are already going through the G20 common framework, but is there talk among member countries in the region to say, perhaps we might actually need to do a sort of preemptive restructuring of some of our debt to stay ahead of the problems that might come our way? If rates remain elevated, the dollar becomes even stronger than it is at the moment, our currencies adjust. It sounds like the logical thing for some of these countries to do would be to try and preemptively restructure some of their debt. Is that a viable option?
So as you point out, countries are facing this big funding squeeze. which the concern is that if not addressed, it could have these consequences of worsening debt problems, of turning what are often liquidity problems then more into solvency and pushing countries more toward the edge. In terms of proactive measures, countries can benefit from more proactive liability management operations, which allow them to change the terms of their debt obligations. And this can be helpful, particularly when they might face a concentration of maturities, and that would allow them to roll over, to mitigate the rollover risks. It's important to note, though, there are also trade-offs then, because often you push maturities or lengthen them, and that might imply higher interest rates.